What is a bridge loan? Well, bridge loans, in my opinion, are one of the most misunderstood loan types in the real estate world. And I want to offer a little bit of clarification about them and maybe how they're used and what are some of the specific details involved in getting a bridge loan. Oftentimes, I see customers coming to me asking about bridge loans because they're in a tight spot. Maybe it's a real estate agent that's asking about it because they're trying to figure their way out of a tight spot, and that usually involves a house that's not selling. So let's talk about what a bridge loan is. A bridge loan is a loan that allows you to bridge the equity out of an existing residence into the purchase of a new residence. Okay, so maybe this house is having some trouble on the market. Maybe it's not selling fast enough. And sometimes people might inquire about a bridge loan just because they don't want to fool with it. They want to take the easy kind of cruise through the loan process and the house buying process so they can move into the new house, close on it, move into it casually at their own pace, and then put the old house on the market. And that's a great idea. Maximum convenience. In what's already a hectic thing, which is buying and selling a house, right? So the problem with bridge loans is that they're not as simple as you might think they would be because they're a big it's a big loan. And so it involves, due diligence, and there are limits and risk assessments and underwriting and all of that stuff. So let's talk about how they work. So we're going to take an example of a $500,000 house. So let's say that your existing home is worth $500,000 and you have a $200,000 mortgage on it. So the remaining balance on your current mortgage is $200,000. Easy enough. That translates into a 40% loan to value on that residence. Okay, meaning that there's a 40% loan on the $500,000 value of that house being $200,000. So most bridge lenders, if you go and you try to inquire about a bridge loan, those bridge lenders are going to tell you that you're probably going to be limited to 80% loan to value in the total combination of the first mortgage and the bridge loan. A bridge loan is a second mortgage on your home. Okay, so 80% loan to value in that $500,000 example would mean that your first mortgage is $200,000. You could borrow up to $200,000 more. You can't get the whole $300,000 in equity, but you could borrow $200,000 more in your home and call that 80% loan to value. So the stronger your equity position is in your current residence, the more available there is to you in the bridge line. So that works out great. Typically, bridge loans to good credit borrowers are going to be anywhere from 2 to 5% over market value for a regular mortgage loan. So if mortgage loans are hitting about 7% right now, 6.5%, 7%, then your bridge loan might be 9 or 10 or 11%. So it's increased risk. That's really not a bad deal. It's increased risk sitting in second lien position. And usually it requires a pretty fast close. And so that's a pretty good deal. But the fees on that bridge loan can be pretty significant because that bridge lender, you got to think about this lender's position. They're not really thinking that you're going to be in this loan for very long. Usually these are kind of venture capital like kind of companies, and they're used to making big profits on their investments. They're not thinking that you're going to be in that house for very long, maybe 60 days. They probably prefer that you're in it less than 60 days because they're not really looking to make money on that 10% interest rate over a 2-month period of time. That's not a big profit for them. Where the big profit comes in is that they're usually going to charge between 2 at the very lowest end. I don't even know that I've seen one at 2%, up to 5 points on the front end. So in other words, when you go and originate that $200,000 loan in our example, they're going to charge you somewhere between $4,000 and maybe $10,000 just to give you the loan for a finite period of time, and maybe that limit is maybe 60 days. And then you're probably going to have an interest-only payment on that loan through the period of time that you hold it. Maybe they defer the payment because they're being really kind, and they just tack that onto the balance. They tack the payment onto the balance. So from a lender position, that bridge lender really wants to turn that money over as quickly as they can. They want you to pay them off in 30 or 45 days. They don't want to collect any interest on you. They want to collect that origination fee on the front end. Because if they can do that 6 times in a year, collect $10,000 in origination fees on that $2,000 or $200,000, then they're really making some money, and they're also going to collect a 10% interest rate over that same period of time. So now their yield is, looking like 22 or 24%, which is more in line with what venture capitalists think they ought to be making. So expensive loan to do, but again, you're talking about maximum convenience, and you're also talking about relieving you of the obligation to sell your old home at the same time or before you buy your new home. So there's a lot of benefit to the user of a bridge loan if you're willing to incur the expenses of it. Now, there's a sticky piece to this because bridge loans sound real easy. Well, oh, hey, why don't you just go get a bridge loan and all this problem will be solved? Well, the reason that's not so easy is because you have to qualify for the bridge loan. So let's think about this. You're in your old house and you've got this $200,000 mortgage on it that you're making your regular mortgage payment that you've been making for the last 7.5 years. You go to the bridge lender and say, hey, listen, I need a bridge loan to get another $200,000 out. And so you need to qualify for that payment at 10%, as if you are going to be holding that for a period of time in the future, an unknown period of time. And then you also have to go to your mortgage lender and say, hey, I want a mortgage loan that will allow me to buy my new house with this $200,000 down that I've gotten out of the bridge loan. So you've got old mortgage payment, bridge loan payment, new mortgage payment. And you have to be able to qualify for all three of those payments for an indefinite period of time in the future, plus all of your other obligations on your credit report, and stay within traditional mortgage guidelines. So you have to be in a really powerful position as far as debt to income ratio. We're doing a lot of ratios here. Your debt to income ratio has to be good. And the stronger your loan to value ratio is, the more money you can get out in that bridge loan scenario. So bridge loans are a great tool, but they're not as simple as you might think when somebody just pops off and say, hey, the solution to your problem is a bridge loan. There are a couple of other ways to bridge money into a real estate transaction, one of which is a home equity line of credit. That takes some time. Home equity loans don't move as quickly in traditional circles in a traditional bank setting. I have a very quick close HELOC. Some are really good for bridging this kind of thing. Others you have to watch for the prepay penalties because you're going to be selling that old house and you're going to be paying it off, and the HELOC is going to go away. There's another tool that I really like to use in bridging value out of a brokerage account, out of a non-retirement stock brokerage account. If you have one of those and you've been doing some savings and piling some money up in one of those, it's called a pledged asset loan. And then there's also the opportunity, if you have an active 401k with the company that you work for, of bridging some money out of that and doing a short-term 401k loan and trying to pull some money out so that you can get into the new house with a minimum down payment. And then when the old house sells, you can bring all that money back into it. But again, for a lot of people these days, with home affordability where it is, home prices, interest rates, the problem is qualifying for all of those loans together. And then, there's some stress that comes along with that, right? Because you have to be prepared to be making those 3 payments plus your other obligations, plus moving expenses and all those things for a period of time, an unknown period of time. And it really kind of puts some pressure on that situation for the home sale, and might put you in a position where you're not getting as much out of the sale as you need to because you're becoming more and more desperate to sell it. So I hope that works to clarify some details about bridge loans. If you have any other questions about mortgages in general, happy to accommodate those questions in any way that I can. Just reach out to me. All my links are in my profile here on YouTube. If you need any assistance directly with any type of mortgage, I'm licensed in Alabama, Tennessee, and Florida, and I have a nationwide referral network, so I'd be happy to get you connected with somebody who can help you out.